Welcome back, guys, and this is going to be a very quick video. In this lesson, we're going to be discussing dollar cost averaging. Dollar cost averaging has been a strategy investors and traders use to minimize the risk from the market manipulation. This strategy has been used to build consistent wealth over a long period of time. It allows investors and traders to select a predetermined amount of their funds that they wish to invest in a menu of financial market over a period of time, thereby reducing the risk of buying at the most inopportune time. Personally, I use dollar cost averaging a lot when I'm not margin trading. So for example, let's say I want to invest or I want to trade on Binance, and when you are trading on Binance, you are not doing margin trading, you are basically buying the physical crypto itself. So let me give an example. So let's assume John has $1,000 capital and he wants to invest in Bitcoin, right? And then let's say one Bitcoin is worth $10,000. He has $1,000, right? So he will be able to get 0.1 BTC, which is 10% of 1 BTC. You get 0.1 BTC because he has $1,000. So assuming he bought once, he would have 0.1 BTC, right? But when it comes to dollar cost averaging, this is what John was supposed to do. John was supposed to divide his money or spread his money out over a period of time, let's say 5 months. So let's say he's going to be buying in January, February, March, April, and May. So why we use dollar cost averaging is because if you spend all your money at once, let's say the price of the particular product you are trying to buy or that you bought went down, you won't have any money on the table to buy more at a lower rate. So this is what we do as investors when you are dollar cost averaging. So we are going to be spreading John's money out over a period of 5 months, right? So we have January, February, March, April, and May. Let's say we're going to be spending $200 per month investing in Bitcoin. So now we started with January. So we bought $200 worth of Bitcoin. February, we bought $200 worth of Bitcoin. We did the same thing in March, April, and May. So as of May, Bitcoin already dropped from $10,000 to $6,000. This means that we have been able to buy Bitcoin as it's coming down from $10,000 to $6,000 over the period of that 5 months, right? If you calculate the amount of Bitcoins, $1,000 we get John at the end of 5 months, it will be way more than 0.1 Bitcoin that he initially got when he didn't use dollar cost averaging. Do you understand this? So the point of dollar cost averaging is to just reduce risk. So if that particular asset drops in price, you will still have money on the table to purchase more at a lower price. So let's say you want to invest in Amazon stocks. You don't want to use all your money to buy in one day. You want to spread it out just in case the price drops. And if the price drops, then you'll be able to get at a cheaper rate. It's basically simple concept, but most people don't think of it. So this is what you should be considering whenever you want to invest. Let's say you are trading on Binance. Do you understand? This will be the end of this lesson, and I hope to see you in the next.